afternoon, depending on where you are. I am Caoilfhionn van der Walt, and with me today we have Cabrini McCarrick, and we are very excited to finally talk about transfer pricing getting real in Mauritius. So we at Regan van Rooy have been in Mauritius for 7 years, and since then we've been saying every year transfer pricing is going to become a reality in Mauritius one of these days. And the Finance Act of 2025 is what has finally brought TP documentation as a new reality in Mauritius. So we are hoping today to give you all a good understanding of broadly what transfer pricing is, what it means for multinational businesses, and how businesses in Mauritius should think about what the new rules mean and how they should be best preparing themselves. So this is quite a complex area. I personally have been working in international tax for close to 30 years, but I know enough about transfer pricing to know that it is extremely complex, and I definitely am not a transfer pricing expert. That's why we have Cabrini here. So it is quite a complex area, and what we would like to do is make it as interactive and user-friendly as possible. So as we go, please feel free to ask any questions, make any comments in the chat section, and we will deal with them as we go. We'll also have time for Q&A at the beginning. But as we're talking, if there's anything that you're not clear on or you'd like us to give more information on, please put it in the chat. And before we kick off, I'd love to hear from all of you where you're based. So are you guys happy just to put in the chat where you're calling from? I'm assuming that we've got quite a lot of Mauritian businesses and Mauritian management companies here. So it'll be helpful to know where you're dialing in from so that we can tailor our comments to you. So yes, we're seeing some people in South Africa. Obviously, lots of South African businesses have entities in Mauritius, so they will need to start rethinking their whole transfer pricing legislation. Yeah, so I see we're mainly in South Africa and Mauritius. Thanks, guys. Okay, cool. So a lot of people in Mauritius have never really had to worry about transfer pricing in too much detail before. So we thought it would be helpful to start with a kind of potted history of what transfer pricing is and the history of transfer pricing legislation. And I will try to do that as the non-transfer pricing person to try and give a layman's summary, and then Cabrini will correct me where needed. But essentially, transfer pricing is the catch-all term for a set of rules that require any transactions between connected parties to be on arm's length terms. That's all transfer pricing means. But of course, the question of what is arm's length is where the complexity comes in. And the answer has generally become you prove it by documenting the hell out of every transaction, which is why transfer pricing studies can be so complex. So when I started my career in the last century, in 1999 in London, I remember meeting someone who was a transfer pricing expert. And I remember asking, what's transfer pricing? And his answer was, transfer pricing is the bedrock of international tax. And I thought, well, that's overstating it a bit, seeing as we had hundreds of people in the international tax team and I don't know, maybe 50 in transfer pricing. But the longer I work in tax, the more I see that that is today's reality. And we often say within our team, transfer pricing is international tax is transfer pricing. So although we're dealing with documentation requirements for the first time now in Mauritius, transfer pricing rules have been around globally for a very long time. The US, unsurprisingly, was the first country to really legislate them, starting from the 1930s, but really kicking off in the late 1960s when rules came in that said essentially group companies need to demonstrably transact on arm's length terms. Then over the latter part, say the 1990s, is when most of the OECD countries started adopting transfer pricing rules. South Africa was a fairly early adopter, bringing in quite comprehensive transfer pricing rules in 1995. And over the last, I would say 10, 15 years, we've seen most of the African countries bring in transfer pricing rules. And the most interesting element, I think, is that in the last kind of 4 or 5 years, we've seen what are traditionally regarded as low tax jurisdictions or favorable tax jurisdictions, or as we used to call them, tax havens. We're no longer allowed to use that term. It's quite un-PC, but tax favorable jurisdictions are starting for the first time to bring in transfer pricing rules. And we particularly have seen that happen in the UAE and in Ireland, and now, of course, in Mauritius. So we're at the stage now where not only can we say that transfer pricing cannot be ignored, but I would say it is the fundamental tax risk facing any multinational. And the documentation requirements are generally governed by OECD precedent, so with rules on what type of folders are required to document what type of transaction and what type of situation. So there is a lot of similarity in the transfer pricing requirements globally, but there are generally nuances in terms of what is a connected person and what types of reports are required to be submitted to the tax authority. As we know, Mauritius has said that it will be bringing out transfer pricing documentation requirements later this year. So this was the big announcement in the Finance Act this year. We know that there is a draft circulating, and our expectation is that it is very much in line with OECD global precedent, but we are waiting to see exactly what those rules will be. So that's a kind of potted history of transfer pricing. Cabrini, anything I have, any glaring mistakes or omissions I've made there?
No, a great introduction. I think maybe just to add is what's really happened in the last few years is probably a multiple of what happened in the last 80. So that's off the back of the base erosion and profit shifting project and what we're trying to create globally in terms of fair tax and a fair set of rules that everybody can comply with, because transfer pricing relates to two or more different tax jurisdictions. And really what transfer pricing is trying to do is make sure that everybody pays their fair share of tax, that they get the right amount of tax and profit per jurisdiction, which is why everybody cares about it. And it's why we're governed by this global set of rules.
Yeah, I think that's a great point, Cabrini. And that's also why transfer pricing is so tricky, because you're not just trying to make one tax authority happy. That's hard enough. You're trying to make sure that both tax authorities on both sides of the same transaction are comfortable with the results. So guys, we're going to share our agenda shortly, but just to give you a more detailed intro to myself and Cabrini. So I am based in Mauritius. I'm the managing partner of Regan van Rooy, and Cabrini McCarrick is our transfer pricing partner and head of our transfer pricing business. We call ourselves an international tax structuring and transfer pricing firm because we regard transfer pricing not just as a part of tax advisory, but as a very fundamental part. Cabrini started her career at Deloitte in the UK. Cabrini is both an accountant and a lawyer, which is always a great start for transfer pricing, and also has a background in economics. So that's the sort of perfect blend for a transfer pricing specialist, because transfer pricing is very, very based on economic principles. So Cabrini was in Deloitte in London, and then at Deloitte in Johannesburg for many years. And Cabrini was very involved in the rollout of transfer pricing legislation across a number of African countries, helping either or both the Deloitte country offices and the tax authorities in country to deal with the new legislation. Cabrini has also done a lot of work in the UAE and Ireland, which are similar to Mauritius in terms that they previously have not had any transfer pricing legislation, but have been operating in as a sort of preferred offshore centre. So lots of the challenges and learnings that we've seen in Ireland and the UAE, I think, will be pertinent to what we see in Mauritius. So Caoilfhionn, can you go to the agenda page, and then you'll see what we're planning to cover today. So as I say, we're going to start with a broad summary of what transfer pricing is. And I think what we always note to jurisdictions that are bringing transfer pricing rules in for the first time is that transfer pricing has been around for a long time. So there are many decades of precedent and court cases and complexity around it. So even though it's to some extent new in Mauritius, there is a lot of global history and precedent behind transfer pricing. So we're going to set the scene in terms of the transfer pricing kind of masterclass. So you'll all know as much as I know, certainly, if not as Cabrini knows, on what is transfer pricing. And then we're going to dig into Mauritius transfer pricing legislation. We're going to look at some of the key Mauritian transfer pricing court cases. And then we're going to look at what do we think the impact will be on businesses in Mauritius, and what we would recommend as the next steps for impacted groups. So I hope that sounds like what you want to hear. As we say, as we go, if you've any questions, any comments, anything you'd like more information on, please put it on the chat. Shortly after the webinar, we will be sending out our slides and a recording of this webinar, so you can watch it over and over again to get the good bits. And also our contact details will be on that, and we're very happy to discuss further with anyone who would like to. So over to you, Cabrini.
Thanks, Caoilfhionn. Kay, can go to the next slide, please. So we just want to start off with kind of a simple question. What is transfer pricing? I see some people on the call are quite experienced in transfer pricing, but the majority really are quite new. And obviously most people based in Mauritius, this is a relatively new concept. So, I mean, Caoilfhionn talked about a bit of the history around it, but basically what's driving all of this is the increased internationalization of business over the last 20 years. The business world has entirely changed. We've moved towards digital. We've got lots of complex structures, and the tax authority are basically getting tax law to catch up with how business operate on the ground. So off of that, the base erosion and profit shifting project kind of started kicking its nose up maybe around 8 years ago with various new updates to the global legislation. Really looking at complex things like how should we treat intangibles, what documentation requirements should you have? And the fundamental premise is to make sure that profit sits in the right jurisdiction. And that's based on transfer pricing principles, and how we determine that we'll go into a bit later, but that's really what goes into your local file at the end of the day. Who does what where? That's what transfer pricing is about. And how important is that what in the value chain in terms of driving profits? So the world essentially is demanding what we call tax transparency. Local files means that there's a lot more information available to tax authorities. So this is why getting our information in order is quite key to this process, because the MRA, as well as all the other tax authorities, can say, give me your local file, or give me your master file. And there's so much information in there that we as businesses who haven't seen transfer pricing before are not really accustomed to giving. So that's something that you need to manage internally. Am I happy with my information? Do I know what information I need? If a tax authority was to look at how I do my transfer pricing practices now, would they be smiling? Or are there things I want to fix? So, and in Mauritius, let's just say we have a tiny window of time. So whilst the legislation is effective August 25, the regulations themselves are still pending. So what do we actually need, right? What we know we need is a local and master file, right? So we know that. So now we have the chance to start reviewing what we're doing and trying to fix any issues within that model before we have to submit a compliant file. And the expectation is we need to do it for 25, but we need to do it right, at least for 26. Businesses need some time to look at and understand how this transfer pricing legislation is going to impact them. So Caoilfhionn mentioned earlier that transfer pricing is a tug of war between tax authorities, right? And that's exactly what it is. If we're selling goods, we're providing services cross-border, each tax authority wants to know they're making enough money from that pie as they would if it was an independent party dealing with it. So that's why they all care, right? They want to make sure the tax is payable in the right jurisdiction and that they're getting their fair share of the global pot or the regional pot, whatever pot they might be looking at. So the principle around that is that profit should follow value creation, right? So transfer pricing, we talked about economics. It's all looking about where is value created, right? Which jurisdiction creates that value? To understand that, you have to figure out how and where value is created in the supply chain. And that kind of talks to the complexity of what goes into your local file, the functional asset and risk analysis. That's delving down into who's doing what and how economically important that function is. The premise being the more economically significant it is, the more money you should earn from it, right? So that's key. It's quite critical in the African context when it comes to commodities that are produced in Africa, for example. A lot of the case law and things happening there has been looking at, well, we've got this valuable thing here. Are we selling it externally at the right price? And looking at this really important value and functions. So the key focus of transfer pricing is typically, and I say typically because it's different in Mauritius, is cross-border related party transactions. We're going to delve into related parties a little bit later. What does that mean for Mauritius? But it's typically cross-border transactions. What's different in Mauritius, and it's also different in about 13 or 14 other African countries, not so much Europe or the Americas, but it's unique to Africa, that we're also looking at domestic transactions. We'll find that is a challenge in Mauritius because we tend to have multiple structures in place and, things that will need to be figured out, right? But it's important to note that we're looking not just at cross-border transactions, but also related party transactions. Okay, if you could jump to the next slide. Caoilfhionn, you can jump in if you have any questions or anything of interest to say, of course. But transfer pricing is based on one simple premise, right? Every place, the OECD, every country. Whether every tax authority applies that correctly or fairly is another question, right? But it's the arm's length principle. We will all have heard of this. And all that really means is if we can't show that something is arm's length, the tax authority has the right to make a tax adjustment to what they believe is arm's length. So this has monetary consequences. If we can't prove it's arm's length, they make a tax adjustment and there's penalties upon that, right? So what does arm's length mean? It basically means that we have to evidence that how we transact with our related party would be the same as if we transacted with a third party. And sometimes people say, oh, that's fine. That's totally correct. We do that anyway. I don't need to worry about transfer pricing. However, you can't just say it or do it. You have to do it in a very prescribed manner. You have to show it and evidence in accordance with the OECD guidelines and local legislative requirements. So there's a very detailed and comprehensive process around that, which we'll talk a bit more later, but it isn't just, yeah, we do the same thing. What you will find in reality is that the terms and conditions of how we transact with our third party versus related party are inherently different. We are thinking as a group, how do we use our group losses? We are thinking as a group, let's make the bulk of our profits over here with a lower effective tax rate. It's very normal, right? So it's a kind of a fundamental relook at things to be able to show and evidence that. And the examination of the terms and conditions of the transactions is quite key. We can jump to the next slide, please, Kay.
And Cabrini, if I can come in here, what I often find a challenge is the unidentified transactions. So the fact that there might be strategic services provided by the head office or management support, but it's not documented from a financial reporting perspective. So people who aren't used to transfer pricing think that then they don't have to pay for it. So that can often be really challenging to identify all of the transactions.
Yeah. You're spot on there. So what we will find generally is the financial reporting around transfer pricing is really poor, right?
Yeah.
Which creates a lot of problems when you do your local file, because your local file is matched to your financials, matched to your tax return, and we're audited if it doesn't make sense. So there is a major problem, particularly in Africa, and it's also particularly in Mauritius, is the non-charging of stuff.
Yeah.
Right? The non-charging of strategic management functions, the non-charging of IP, and the biggest one that's super common, obviously, in Mauritius is no interest on loans and not having to worry about that before. So all of these things, a lot of people, right, if you have an operation in Mauritius, you obviously have most likely dealt with transfer pricing on the other side. And we always say the risk is in South Africa, the risk is in Kenya, the risk is in Ireland, wherever it may be. But now, because we have to document this from a Mauritian perspective, we actually have problems to fix. They're not, I don't know that there's many people in Mauritius that would be able to go hand on heart, yes, I've got my transfer pricing covered, because even the advisors would have said to them historically, yeah, well, the MRA aren't so active in this space. We actually don't have legislation. We now do. And those kind of non-charging ones means that a tax authority basically determines what is the arm's length value of that? And when they're determining it, it's never favorable to the tax authority. And then they want to recharge that. And then you have adjustments and then you have penalties. And then they look back historically. So the non-charging and the non-reporting, the non-accurate reporting. So the very first stage of all of this for anybody is, well, identifying first, who are my related parties? And two, what are my transactions? And that in itself is complex. But essentially, the onus is on the taxpayer, right? So we've had loads of recent case law, some case law in Kenya, some case law everywhere. And what I can tell you that's happened across Africa is if you don't have documentation, you have no defense. There's not been one win by any taxpayer who then argued after the fact, gave evidence after the fact, decided to do the work after the fact, that's actually won a dispute. Because it said you weren't compliant, you had the opportunity to show us that information. The onus is on the taxpayer to evidence the arm's length nature. And if you don't give us that evidence, we are going to adjust to what we see fit because, guys, you didn't do your homework and you weren't compliant. And this is why your documentation, your local file and master file, is absolutely critical. It is your defense narrative. It is your voice to the tax authority to avoid an audit. And I think that has proved time over time that what's in your documentation, doing your documentation is absolutely fundamental to managing an audit process. So one of the big focuses, and this is going to become quite important in Mauritius, right? Transfer pricing is all about economic substance over legal form, right? This is critical. When we talk about where value is created, it's not just a paper transaction. It is not just the legal signatory. It is the economic substance and activity around that. The individuals or the significant people function have the ability to manage and control risks. One of the issues we've been talking about in Mauritius for a long, long time is you have to have appropriate substance in place. That means significant people employed in location doing the functions for which you're being remunerated, right? Now, often case we would say, but that's the other side's risk. That's South Africa. We've got loads of profit here. We're not worried. But now you have individual auditors going in. They don't just care about, the outcome. They actually are trying to apply the letter of the law. I'll give an example of what's happened in the UAE now, who have the big player who's obviously took in new tax rules, but also transfer pricing. The level of compliance is way higher than I've seen in Europe or globally. The auditors are not letting anybody pass with anything. They're not taking any risk when it comes to transfer pricing. In those cases, even if there's thresholds not met, even if the transactions are in some case immaterial, because they don't actually know if they don't know the value, so an auditor can't determine if it's material or not. So the expectation is that the same will happen in Mauritius, that the regulatory compliance and the audit review process is going to make this critical. So it's not just your tax authority or your own business that you're thinking about is, can I get my financials signed off, right? I think that's really important because we're currently dealing with a number of major businesses that can't get their tax return done because they haven't done their transfer pricing. And that's pretty poor situation to be in, because of course it's a target of the tax authority anytime you're late or do anything out of the ordinary. So anyway, why does all of this matter? You know, the value chain, what people do where? It's because the fact pattern of your business and the economic realities actually determine what amounts to an arm's length remuneration. So it's who's doing what, where are they doing this? What is the economic significance, which is linked to function, risk, and asset in the value chain? And how much do we get paid? And that's what our local file is fundamentally supposed to support. We've done the functional analysis. This is what everybody does. This is how we've classified it from a transfer pricing perspective. Our legal agreements support what we say. And now we're going to benchmark an arm's length return for that, and then we're going to apply it going forward. So it isn't just to say, yes, we do everything like a third party, we have the same pricing list. You actually have a very comprehensive process involved, the onus being on the taxpayer to evidence that. We can jump to the next slide, Kay. What is transfer pricing influenced? So we talked a bit about basically BEPS, the Base Erosion and Profit Shifting Project, tax transparency. The whole world of tax kind of changed. Like Caoilfhionn said, we talked about tax havens, tax planning, all of that. The world basically stood up and said, no, it has to be fair, particularly developing economies. ATAF is doing an absolute ton of work in Africa. The OECD is doing a ton of work in Africa, right? There's this perception that there has been an erosion of tax bases in developing countries and in other countries, right? We've massive cases in the US, in Europe, every place. But this new legislation is basically making the tax authorities upscale themselves and focus on, first of all, compliance, and second of all, transfer pricing audits, right? So all of this means that first we've got to get compliant, and second, in Mauritius, we need to prepare ourselves to defend our positions, because of course, after they check compliance, they look at your local files and the audit process starts. And that's the really torturous piece. That's the really torturous piece. I wanted to just say on that point, and we have a couple of Mauritian cases later, the MRA is already super active here, right? They've got live transfer pricing court cases, challenging interest-free loans, challenging management fees, challenging IP, kind of on every type of transaction. They've got cases and they have won those cases. They've been successful in those cases. And fundamentally, there were some issues in those cases in terms of transfer pricing. So they are active here, but the trend is, what we've seen in Africa is they will basically bring in this documentation legislation. Then they focus on pure enforcement. So you have to have your local file, but this time, do they have the local file? Red tick, green tick. Okay, they have the local file, and now are they worth an audit, right? So their investment is enforcement in terms of compliance, and then audit the ones they think have an issue. That's what's going to happen in Mauritius as well. In fact, it's already happening. So there's a lot of focus in terms in transfer pricing, right? Politically, it's a political topic. It's a moral topic, right? It's often talked about. If you're perceived to be shifting profit from a developing country or any other country, it's not a good look. There's been reputational impacts. You will know some of the coronation cases, and there's been changes in those results. The share price dropped. There was a bad transfer pricing result. The share price plummeted, right? That's the type of impact. And that's why your stakeholders are interested in this, because transfer pricing, getting it wrong, is linked to reputation and tax transparency and being a good taxpayer, which is essentially what most people need to be these days. Transfer pricing is also influenced by internal forces, right? So the first thing that poor businesses in Mauritius have to do is they got to figure out their compliance burden and they got to get that work done. However, it is typically a rethinking. There is often a restructure or a remodel designed. The first time you take in transfer pricing, it wasn't set up potentially with transfer pricing in mind. You don't just document what you did. You may have to make some changes. You may have to update legal agreements. You may have to recheck policies. So getting a sense check on where you currently stand is really, really critical so that you can try to manage that gap before you're submitting something to the tax authority, which is typically with the tax return. So the expectation is with your 25 tax return, you'll have to have a local file ready, or with your 26. So we need to use that window so that we're looking nice and pretty by the time the MRA is having a look at this.
And if I can come in there, Cabrini, because I think that's a really good point. So as we've said, transfer pricing is multilateral. It's not just relevant to one country. So you change your transfer pricing position at your peril. Basically, any change in your transfer pricing will lead to queries from two sets of revenue authorities. So what we say is the first time you're doing your transfer pricing report, where we will be in Mauritius, you don't just start documenting. You first need to review thoroughly what's going on and is there anything I want to change before I put pen to paper and commit myself to my very first local folder. So now is the time for businesses to look at their position, understand their transactions, and understand if there's any risks or restructuring opportunities that they need to consider before they start documenting.
Yeah, thanks, Keelan. And maybe just one more point on this slide, and we'll talk about what goes in a local file. Some people are very familiar with that. Some people, we're still talking a bit nonsense. These words it might take a little bit of time for these to come clear. But what we have with a local file, right, it's the document that has the functional analysis and has the benchmarking and uses the numbers from your financials and your tax return to evidence the arm's length nature of the transactions. So one of the issues that's key is your financials, your tax returns, your legal agreements, as well as your local files tend to not be aligned when you start the process. And part of this journey is to get them aligned, right? To have mapping, to be able to map things, to figure out any issues so that you can have a robust position going forward. Okay, you could move to the next slide, please. Who cares about transfer pricing? I'm guessing the people on this call care. So obviously the tax authorities and the global regulatory bodies, why? Because they think there's a load of money in it, right? And Africa thinks there's a load of money in it. They've actually just building a brand new, I don't know how much information I can share about this, but in South Africa, they're further expanding their transfer pricing capabilities. This is the trend every place, right? The tax authority are invested in transfer pricing. And invested in terms of there's bigger money in challenging that than many other taxes. So they're going to go where the money is. Taxpayers, obviously, right? But your stakeholders, this is one of the things that we always say about transfer pricing. It's not just your finance manager, your tax person. This impacts where your money sits, how much money is going to come out of it, where your profit is taxed. That's fundamental to your top dog C-suite people, right? They're going to care. They're also going to care if we're doing something incorrect and it's got a reputational damage that's impacting my share price. I had a recent example of a major African group that wanted to sell off, and 30 million US dollars was taken off the value of that sale because of transfer pricing exposures. In that case, it was nobody thought about where the IP sits, who actually owns it. So it isn't just a tax compliance, a simple thing, we're all arm's length. It's really fundamental to the health of your business and where your profit sits and how much tax you pay holistically as a group. We could jump to the next slide.
And Cabrini, maybe if I can just add on that, tax authorities love transfer pricing because, let's face it, it's the easiest way for them to challenge a taxpayer that he's not paying enough tax, because all they have to do is say, I don't agree that your charging is arm's length, and it pushes the onus to the taxpayer. It's not like an argument that, a deduction shouldn't have been allowed, which requires a technical write-up. All they need to do is say, I don't agree, it's arm's length. it leads to a full-scale audit with a lot of work from the taxpayer. So it's regarded generally as an easy win from the tax authorities, and we're certainly seeing in Mauritius that the MRA is quite aggressive, and they have been over the last couple of years, but they are starting to focus more and more on transfer pricing.
Absolutely. So maybe just to think about what transactions does this impact, right? So I'm a Mauritius entity. I've got, I transact with the South African entity, or I have a couple of different Mauritian entities. What are the transactions? It's very straightforward. It's everything. So any type of services provided, whether paid or not paid. That's like I do a management. I do a management support. I do a technical support. I do a central IT support. Any type of service. I'm giving engineering support to a project. I'm helping on the business development side, whatever, any type of service. Goods is an obvious one, right? Goods, am I selling any type of goods between any entity? Goods is normally high value, of course. Intellectual property, and this is the one that we have had like 6 or 7 recent case laws about, including a big one in South Africa, another one in Kenya. Oh, where is the IP? Should other people be paying us for the IP? Should they not? Right. So if you own the IP, you need to support that you do actually economically own it, not legally own it. And if I do economically owning it, are there other people using it? And should they be paying me? Because that's money that the taxman wants a bite of. Or if we are we paying the arm's length value? Huge, huge value, especially in the new age where we have so much tech businesses happening across Africa and these key hubs, so much happening in the digital space. Intellectual property is actually becoming more and more important and difficult to define, but it's super high value because it can be considered a key value driver in the business, i.e. who's managing, controlling that should have a decent share in the profit. But of course, substance, significant people function is required to show that. Low-hanging fruit for tax authorities, we've seen it already in Mauritius. They're looking at substance, they're looking at significant people functions, they're looking at loss-making entities, they're looking at procurement hubs, back-to-back transactions. So what's the commercial rationale for this transaction? This is a key one. Did we set something up because it gives us a nice tax answer, or do we have an actual commercial rationale for this transaction? If your core business is related party, you're a very easy target because that means all your revenue and all your profits is up for grabs. And a key one, and we'll see a lot of it in Mauritius, we're starting to see it now as we start to work with Mauritian groups, restructure, right? If you have an existing policy and you're doing any type of restructure, your transfer pricing policies don't stay still. They have to be considered, and there has to be, normally with the change in business model, there's a change or an evolution of a transfer pricing model. And we've seen a number of cases, they tend to be very complex, that the tax authorities are starting to hone in on those restructures, especially where there's some level of public information available around them. There may be mergers, acquisitions, lots of things going on there. But it's an interesting space. Kay, you can jump to the next slide, please.
Cabrini, can I just make a comment there? So 2 points. One is that the whole understanding of the tax around IP has fundamentally changed in the last 8 years due to what they call BEPS Pillar 1. It used to be, and I still see a remnant of this thinking in Mauritius, it used to be that wherever your IP is owned, that's where all the revenue relating to it can sit. But that concept has been completely debunked by this DEMPI principle that Cabrini mentioned. So just to beware, if you have a structure in Mauritius that involves IP, there has been a lot of very complex anti-avoidance movements around the taxation of revenues relating to that. And the second point I want to raise is substance. So there's a lot of talk about substance in Mauritius in terms of the Mauritian requirement to have sufficient substance for operating your business in Mauritius and being tax resident in Mauritius. That is completely different to what we mean from a substance perspective for transfer pricing. So substance is one of those catch-all phrases that can mean different things in different contexts, but from a transfer pricing perspective, real economic substance is absolutely key. And do not think because you've ticked the box in terms of Mauritius's own country substance requirements for having your company, that your substance analysis is complete from the transfer pricing perspective. It's two very different exercises.
Yeah, great point. And it's basically the biggest risk area globally in terms of not having that substance to support the value creation and link to the significant people function. That means, is the person who can, do I have the financial capacity, the skills, the authority to make the decisions with respect to that? I must be an employee of that entity, right? It's not other entities or independent advisor, right? Can I fundamentally, as an entity, bear this risk and look at those functions? So I think substance is absolutely critical, big problem in Mauritius currently, and is very likely to be subject to a very rigorous review in the next 12 months, I'd imagine. Very quickly on the transfer pricing life cycle, because we haven't started to talk specifically to Mauritius yet, but it's pretty straightforward when we get to Mauritius, really. So the first thing that all the Mauritian entities need to do now is look at their transactions, look at their existing policies and sense check. Is this fine? Do I need to change anything? What do I need to do? Then you go to your documentation and benchmarking. Ideally, and this is quite key, the first time that we have to give the MRA a transfer pricing document, we want it to look great. I seem to have an internet issue. Did I drop there for a moment?
And no, Cabrini, all good.
Oh, okay. So the key issue is to try to get the right answer before you do your first logo file. So that should be kind of the key thing to sort out. Obviously, further down the value chain is dispute resolution and controversy management. We want at all costs to avoid this. And as we go, remember that transfer pricing, it's not just a once-off exercise. You have to do this every year. You have to do a local file every year. In every country, it's every year. It's not just I've done one and now it's perfect. You have to update it every year. And so we've got to implement it and monitor it in terms of the business. Let's jump quickly to the next slide, please. You can keep going to the next one. So to be clear, the Finance Act is there. It's already in place. From August, we have, we know that we have to prepare local and master files. What we don't know is when, but typically we know that it's going to be at the time that you file your tax return, right? We know that it's going to be effective, and we need to look at 25 and 26. And what we don't know is whether or not we have to submit this document or hold it. And what we also don't know is whether or not there will be a threshold, which means we don't have to prepare this local file, right? So there is some points of clarity, but we do know we need to prepare local files and potentially master files in Mauritius now. So that's the big news. You can jump to the next slide. I think it's maybe 2 slides on. So the change is really around Section 75, right? So they've already relied on this section to do audits and to say that, things have to be transacted at an arm's length basis. But if you go to the next slide, Kay, I just got to talk to the specific changes in there. Caoilfhionn, am I still here? I seem to be on a freeze.
No, all good, Cabrini.
Okay, all right, okay. So obviously we have the Section 75 that the MRA have been relying on to do transfer pricing audits, a bit like Zimbabwe did back in the day. They relied on the anti-avoidance provisions and, have been applying it historically. And then we have the Finance Act 25, which came out in August. And this is where finally we're introduced with you have to retain documents and prepare local and master files, okay? Mauritius already have country by country in place. We've submitted for a number of clients the country by country reports, probably the last 3 to 4 years. So they're quite advanced in terms of that. Kay, if you could skip forward, it's actually the next slide I want to talk to. So this is where it gets interesting. This is where it gets interesting, okay? What did they change in Section 75, right? First, they're saying you must prepare and keep records in a manner prescribed by the regulations. The regulations is what we're waiting for. But the what, because we've had discussions with the MRA and the regulations are floating about now, that's local file and master file. The second key issue is who has to do it, right? What's a connected party? And I think it's important to make it clear here that this definition of a connected party is very wide. It is in line with OECD associated enterprise type definition. So one who controls the business or income earning activities, the other, whether such control arises through relationship or any other means, kind of broad, where the activity is carried out in or from Mauritius. What's important is that control includes ownership. We all kind of know about that, but it includes management influence, economic dependency, or operational direction. That is super, super wide. And it's super, you'll kind of know yourself out there if you have various structures in place which may not show directly a legal ownership, but it is very, very wide, right? So we definitely need to be analysing as a first step, who are our connected persons? Do we have any? If we have none that meet this very wide definition, happy days. But this is the key one, because it isn't just look at your legal ownership percentage. It's look at the board of directors. It's look at management and control. It's look at who's making the decisions. So it's very wide. South Africa introduced the associated enterprise definition recently. It is important to note that economic dependency, and this example was actually given in the OECD guidelines, can even relate to a third party. If we have one customer or one supplier, right, and we are economically dependent on them, even if they're a pure third party, due to the nature of that relationship, if they were influenced by their decisions, they could actually fall under the definition of a connected party. Now, that's kind of the far end of the stick, but we are seeing that being challenged. Some jurisdictions, and let's hope it's not Mauritius, have taken in the definition of a deemed associate. And a deemed associate basically covers a much wider range similar to this. So it's like, we don't care about your legal ownership. Unless you can show me X, Y, Z, you still have to do transfer pricing. So this is very, very onerous and complex, and we do need to get a grip on that and manage that as kind of as a key matter.
And Cabrini, if I could come in here. So as we've said, we've seen a lot of traditional low tax jurisdictions bring in transfer pricing rules. And often they've brought them in sort of defensively to try and keep on the right side of the OECD requirements. So we saw a few years ago, Mauritius brought in controlled foreign company rules, but they didn't really have any teeth. They wouldn't really apply to anyone. And we might have expected that the TP rules would be similarly sort of non-scary. But this connected person definition is very scary. This is one of the broadest connected person definitions I have ever seen. It was only, I think, last year, Cabrini, that South Africa extended its definition to include associated entities. So Mauritius has come in with that right from the beginning. And this element where it can also include third parties is very, very broad. So we have to assume that the MRA is not bringing in transfer pricing rules to keep the OECD happy. They are bringing in transfer pricing rules because they want to levy more tax on increased revenues in Mauritius.
Yeah. And yeah, I think, look, it's super important, because what they've done, Mauritius, is kind of waited for everyone else to take the legislation in, look at all the best bits of it that suits their economy, and taken all of those on board. So the definition of connected person is super wide, and the fact that it's domestic and cross-border, super wide. So, and I'm sure we're going to see in the regulations, such as countries like Malawi or others, Eswatini have done, they may have a specific focus on areas where they see themselves that they have a problem in Mauritius. They will have some local, and they'll say, well, actually, we think we're missing out on revenue from somewhere, so let's make a little tweak on the legislation to deal with that. Like there's been some tweaks in terms of commodities in Africa. That won't be a Mauritian issue, right? It'll be something else, you know, in terms of maybe strategic management or something. But Kay, we can look at the next slide, please. So now we're talking about the what. So we've kind of talked about this before, but in your local file, you have these key components. It's called the functional analysis, which is very detailed and forms a prescribed format. You have to basically, what does each party to the transaction do? What assets do they utilize, and what risks are borne, right? That's a critical part of the analysis that needs to go into your file. And then you have to classify the parties to that transaction. Then you have to do a selection of appropriate method. You can't just use any way you want to support this. The OECD guidelines, and Mauritius has said they would follow these, have a specified number of methods. The TNMM, a COP, resell minus, there's a couple of methods, and you can only use one of these prescribed methods to support it. So it's a highly technical piece of analysis to do your benchmarking studies. Benchmarking studies are done on independent databases, right? Typically the BVD, the Orbis database in Africa, that's the one MRA has access to. It's the ones that the South African tax authorities, nearly most of the African tax authorities have access to. So these aren't just things you write up yourself on the back of your fridge. It's very specific, it's very technical what's required. So, which is why the advice is that for the first time doing it, we need to get proper advice on what goes in here and make sure that we start this off kind of compliant and looking good from the outset. In terms of timing, we've already mentioned this. It's 25, 26 that we'll need the local file ready for. But be very aware, tax authorities are auditing retrospectively. So even if we didn't have a documentation requirement, the previous section 75 still says you have to transact at an arm's length. So we do need to be cautious to manage any historic exposure and at least understand them, right? If you're the tax manager you're doing locally, you at least need to understand if you have an exposure, because somebody needs to be made aware of that in the context of the business. It's not something we can sit on. So that's something to consider as well. Let's jump to the next slide, please, Kay. What does the new rules mean for businesses? And I hope everyone doesn't have a big headache after listening to all of this, but it's a big compliance burden. It is a big compliance burden. There is a lot to do, and there's a cost attached to that, particularly in the first year of implementation. It is a necessary and worthwhile investment to do it because you really don't have an option. Right? You don't have an option. There's not like, well, we don't really worry about that, because we need to understand the exposures, the penalties, the non-compliance, the timing a transfer pricing audit actually takes from our resources. So risk management becomes more important now, and documentation, as always, is the first line of defense. Without a documentation, you are sitting essentially in the tax authority's hands. To understand this idea of transparency, right? Our information, our financial information, is no longer just for us and our CFO to sit around and talk about. Our information can be requested by various different tax authorities and scrutinized. Are we happy? Are we comfortable with our numbers? You know, if we were to provide this legal agreement or that legal agreement, are we comfortable? We're covered, right? Because information sharing is all over this, and what goes into your local file, South Africa can look at it from a Mauritian perspective. Various different jurisdictions can look at it, right? It's very important to understand that we have less control over our own data now. Costs, like we've mentioned, there is a cost to this. You're going to require external benchmarks. You're going to require local files to be done. The first year is by far the more expensive. After that, you manual upkeep, and you only need to do a big expensive exercise if there's a major change generally, right? But the first year, you need to be flagging to the relevant budget makers. To do this right in the first year, you got some money to spend now, and that will become less over time, but it is annual, so it needs to be accounted for in budgets. We need to actually kind of think about compliance here. And then managing exposure. It is highly unlikely that everything we're sitting on is perfect, right? We are going to likely need a mitigation strategy. We're going to have to at least run some numbers and make sure if we have any issues that we're aware of those, and that our narrative in our local file the first time MRA or another tax authority looks at us is as pretty and as tight as possible, so that transfer pricing can become significantly less of a burden or a complexity for the business going forward.
Cabrini, we have a question on that point about managing exposure. And this is a good question. It's one we have seen very often arise also in Ireland and Dubai. And the question is, surely there can't be any extra tax payable in Mauritius, because the entire point of setting up in Mauritius was to push as much profits there, as it's a lower tax jurisdiction, as possible. So the answer is, you might expect that, but that is not the case. And that's why, and I'll let Cabrini answer more technically now, but that's why also we were flagging how broad the connected party definition is. This doesn't look like transfer pricing rules that are a SOP to the OECD to tick the box and show we have transfer pricing rules. These look like very broad transfer pricing rules. And when you tie that into what I think we're all seeing as increased aggression from the Mauritius revenue, we do think that there will be many companies who are obliged to show more revenue and thus pay more tax in Mauritius. And I think added to that, and I'm going to try and word this carefully, often in jurisdictions where we're dealing with transfer pricing for the first time, we have a tax authority that is, incentivized, like always, to increase the tax revenues. So they're very aggressive, but not always very nuanced or experienced. So often they can be more aggressive than you might expect, even in a country like South Africa, because they just don't have the experience of dealing with transfer pricing disputes in a kind of rational way. So they can go after quite, spurious amounts. And I think what we're seeing in Mauritius is that even interest-free loans between two Mauritian resident companies are being challenged. I mean, that makes zero sense. But so unfortunately, I would say we cannot assume that because Mauritius has traditionally been a country where people try to reflect higher profits, we cannot assume that that is not going to result in transfer pricing adjustments. And that's what we're seeing in Ireland and what we're seeing in Dubai. Cabrini, will you add to that?
Look, it's also what we've seen in the 3 court cases that the MRA have had in the last few years, deeming interest on finance transactions. They want the withholding tax, management fees, withholding tax. We want the amount, whatever taxable income. So we've already seen that in practice in 3 or 4 cases. But also I think it's important that, yes, the risk not normally is we have, we can say that we have 10 excess profits in these jurisdictions, and the risk might be on the other side, right? But now this gives South Africa to say, where's your Mauritian local file? Oh, I didn't have to prepare one before. Oh, now you have to prepare it. And then how do you get a transfer pricing expert to do a local file that substantiates that? So this can be used to increase or heighten your risk in your other jurisdictions as well, because now you have to prepare a local file. A local file says this transaction is arm's length. So how is anyone going to comply with this legislation without showing it, right? So the risk is both wherever they're missing some money in Mauritius, but also on the other side, because you have this local file that's got to be done by someone, or you're not compliant, and then that is available to other tax authorities. It's another tool that's used to scrutinize from both sides of the equation. But just conscious of time, if we could just jump to the last slide. I'm not sure. I won't go into these court cases. You can just jump to the slide, but what you'll see, what's been happening already. So they've looked at IP and they looked at loans, right? And they've also, 2 matters that we're currently looking at now is margins for procurement hubs, commodities, stuff that's flowing in and out of the country, but they're not actually coming into the country. So these kind of back-to-back transactions, they're currently being challenged. Management fees, the non-charging of management fees. So that's live, that's happening. The tax authority themselves is not always aligned with the wider political view of a country. And Mauritius as a whole wants to be renowned in terms of international best practice. Similar to Ireland, right? They had a big court case. They wanted to keep their low tax rate. They've taken in the minimum tax rate. There's nobody escaping this, is we need to align to international best practices. It's still absolutely a key hub for Africa, still wonderful tax rates, wonderful benefits, but there's going to be a shift and a change in that that's going to impact over the next number of years our taxable outcomes. And I think that's kind of key to understand at this stage. On to the last slide there. Opportunities and challenges. I know, no, you can go back a second. I know we didn't talk too much about opportunities, but remember, there's always opportunities with transfer pricing, right? So one of the things that the government is talking has happened in other jurisdictions is increased credibility for Mauritius as a compliant investment hub, right? Which is critical to the Mauritian economy, and being aligned with global best practices is ultimately, over time, expected to be a good thing. We're still going to have wonderful tax benefits. We're still going to have wonderful infrastructure, but we need to deal with this headache. And why? Because everybody else has done it. Seychelles has done it. Eswatini's done it. Ivory Coast has done it. Ireland has done it. You know, it's happening there. There's also what we're seeing is actually building true substance in Mauritius. So how to make your models work through substance. If you go to the beaches of Mauritius now, you will find very senior chief executives and CEOs, significant people function sitting on those beaches beside Caoilfhionn drinking their martinis, I don't know. But having your substance there gives you a very good business model and taxable outcome. That's been happening already. That's been happening for the last number of years. Just see who's sitting on your beaches, right? Why are they there? It's because they're generating true economic substance in often cases. The challenges is, of course, is you got new costs, you've got a compliance burden, you've got to get your stakeholders on board. Why do we need to do this rubbish? And we will see over time, we do need to do it. And whether or not we've got immediate restructuring issues. So do we have any problems and how do we fix them before we're submitting something to the MRA that is going to create headaches for us? So timing in terms of this, I would say, is absolutely critical, and getting the basis right and digging under the bonnet of the car to understand what you need to do is just absolutely critical. Hopefully some of you have very little to do, but we need to understand that. I mean, to understand any type of exposures we're doing so that we can successfully manage this. Caoilfhionn, I'll hand it over to you.
Yeah, I see we're just out of time, and I think this shows that there is a lot to discuss here. What we want you all to walk away thinking is that transfer pricing is a game changer in Mauritius. The transfer pricing documentation is not going to be just simply taking the documentation that the other countries in the group have prepared and kind of putting Mauritius on the cover and submitting it. It is a significant change to business, and there is a once-off opportunity to relook at your business and fix anything you need to fix before you start documenting. So we are fairly confident that we're going to see the regulations from the MRA over the next month or so, and we know pretty much what they're going to say because they're in line with OECD requirements. And again, the answer is document, document, document. So the key risk for entities that are doing the transfer pricing for the first time is always ensuring they document everything correctly. So making sure you're aware of all your connected parties involved, bearing in mind that the definition of connected parties is extremely broad, and most importantly, that you're aware of all of the transactions that are happening between connected parties, especially those that are not currently reflected in your financial statements, because what isn't, you know, it's what you don't know that will trip you up when you're doing your transfer pricing for the first time. So we will wrap it up there. Thank you all for your attention. We will send the slides and the recording as soon as it is ready. You have our emails in the slides, so feel free to contact us with any questions. Otherwise, thank you, Cabrini. Very helpful, very interesting discussion.
Thanks, everybody. Thanks, Caoilfhionn. Thanks, everyone, for joining us. Great crowd today. Appreciate it.
Bye, guys.
Bye.